venture capital, if it's my responsibility to share this, venture capital is one of many ways to attract capital in your business. It's not the only way. And I've seen a lot of founders fall into a trap of thinking that venture capital is the place where they can get the money they need to start their idea, their business, their startup. And if they're not able to get venture capital, they're not going to be able to pursue that particular idea. I just want, again, it's my responsibility to share that I've seen so many businesses, especially over the last few years, that were able to tap into traditional debt, venture debt, revenue-based financing, a lot of grants, definitely more true for our European friends rather than US, but still even in this, a lot of grants available, especially if you're building something very technical and there has a scientific purpose to it. Product crowdfunding for people who are building actual physical goods or services, and obviously, revenue, building something that people are willing to pay you for, the best way to get capital. Now, with that being said, venture capital is very attractive and it's been significantly popularized, specifically over the last 10, 15 years, through a lot of successes and also some really famous lack of successes or failures, however you want to call them. What I would say, though, as someone who's seen thousands, probably in the many thousands of founders over the last decade or so, and have worked with hundreds of founders throughout my time, both in venture as well as Flowlie, is that a large amount of founders who end up going the venture route and raise venture capital are not actually making the right decision to find venture capital as their source of funding. And what I mean by that is they haven't asked themselves these 8 fundamental questions. And we'll go in just a second over why those questions actually are really important and what's the economic relationship that you end up forming with your investor, deciding, effectively the fate of the business as a result of the answers to these 8 questions. When you're looking at your business, that's step number 1, and reflecting on it, does it really have a clear path to $100 million in annual revenue? And more important than that, can it reach that level of scale in the next 8 to 10 years? The reason behind it is the types of bets that VC firms make are by default required to be really bold bets, which is why you don't really see more regular businesses being funded by venture capitalists. They may go private equity, family office, angel investors, etc. I'm bundling all of that out of the scope of VC as a traditional VC firm, Sequoia, Andreessen, Accel, you name it, a firm that's been formed to invest in technology startups. They're looking for these outliers. And the reason behind it is about 80% of their investments will go to zero or will return less than 1x. So less than the amount that they invested will be able to get back. Meaning the 20% of them that do succeed have to create these outside outcomes. If you're familiar with the terminology, there's been a lot of talk around it because there's a book published, I think about a year ago on it, the idea of the power law and the power law distribution. There are certain outcomes that are exponential, and chasing those outcomes results in the majority of the returns. So by default, this business model has to be highly scalable and must have some form of exit path, either an IPO or an M&A in the next 8 to 10 years. Do I suggest founders obsess about the idea of the exit early on? Not at all. However, I think you'd be foolish not at least ask yourself in the beginning of starting the business, and even as you're attracted, let's say, a pre-seed or potentially even a seed, 1, has there ever been a public listing in my industry, more broadly, or my space? Have any company in my particular industry reached a scale high enough or large enough to be able to be listed on a public exchange? If the answer to that is no, there may be a question, is the market large enough to be able to support those types of companies? Second, on the M&A side, are there any large companies, period? Don't have to be public, they could be private, but is there a company large enough, or a few companies large enough, we're talking 100 million, 500 million, $1 billion in revenue, that exist in my industry? And again, if the answer to that is no, it may mean that the industry itself is just not large enough to be able to support that. If the answer to all of those is yes, the idea is revolutionary enough in the market, large enough to be able to get $100 million in revenue, built to do so at scale, 8 to 10 years, and doesn't require a ridiculous amount of investment to make it happen. And I know that some of you may say, Vlad, but what about all the more recent AI investments that require a lot of GPU and compute, yes, there have been some shifts to more CapEx intensive industries, almost entirely related to AI and data centers. For the vast majority of other CapEx intensive industries, think of real estate, restaurants, and everything else, manufacturing, there hasn't been as much venture backing, and neither in the past nor in the present, most likely not in the future either. However, when you're looking at yourself as a founder, you have to understand that the more capital you raise, the less ownership and control you have over your own business. And I think founders forget the part that the board is responsible for hiring and firing the CEO. They tend to remember the first and forget the second part of that sentence. And the reason why this is so critical is that the more you have an investor, especially as a lead investor, that joins the board and has certain ownership or economic control over the business, they'll be decision makers in your organization. In the beginning, you won't feel like much because their ownership percentage is small. Their involvement in the board is not going to be as high. The further along you go, Series A, B, or C, the more of that control they'll be able to exercise over the company. And you must be very comfortable with the idea that you as the owner may not actually be the ultimate decision maker overall. And I've seen great board relationships and I've seen some really bad board relationships. And I can tell you, making the right decision is really, really important. Obviously, being great under pressure and willing to exit are non-negotiable because this is going to be a sprint of 8 to 10 years in which at the end, ideally, you will exit. So not plan to run a lifestyle business. Now, why is this the case? Why do we spend all this time thinking about all these requirements to get venture capital and why it's so important to make this decision? Because of this, and it may seem scary in the beginning, I'll try to break it down into pieces. You will have the presentation available after this. We're also recording it, so you'll have the recording link. But when you look at a VC firm, you'll realize that there's a few people that are at play here. The GPs are the general partners. You probably see them on a website. They're the ones who own the particular firm. But there's also these people called the LPs, the limited partners. Those are actually the families, pension funds, endowment funds, or just wealthy individuals that give the GPs the money to make an investment. And the GPs go to these LPs to say, hey, we need money. We want to deploy in this particular thesis. Therefore, we will raise a fund. Are you interested in investing or not? So they create these funds called limited partnerships. Now, why is it really important to make the decision between a fund and a firm is that a firm can have multiple funds. So when you are looking to get an investment from a firm, you are actually getting investment from a fund they manage. Now, this is really, really, really important. Why? 2 reasons. 1, fund life. 2, powder. Fund life. Every single fund that this firm is creating usually has a fund life of 10 years, meaning the LPs gave money to GPs and said, GP, go ahead and invest this money. In about 10 years, I want my money back, meaning you have to make an investment, accelerate the company, and sell the company in those 10 years. Now, most funds do get extended, usually by 2 or 3 years. So usual fund life, somewhere between 12 and 13 years. But with that being said, there is still a timeline, meaning you don't want to raise investment from a VC fund and tell them that an exit will happen in 20 years because it will just not be compatible with the model. Second is the concept of dry powder, meaning the fund is raised. If there is a fund of $100 million, they raise $100 million and then they deploy the $100 million. Doesn't matter that the firm, let's say, has a AUM, also known as assets under management, of $1 billion, let's say. Cool, not really helpful for us because we got money from this fund. Let's say Sequoia, and they raise a fund that's Sequoia Biotech, and we get money from Sequoia Biotech. That's owned by certain GPs inside Sequoia. So if that fund runs out of money, they don't have additional money to invest in us, and we are counting on Sequoia saying, oh, Sequoia just has a lot of money, they'll be able to find money for us. Inside the organization, they'll have to actually convince other GPs to make investments from other funds in you. And I have multiple funds with different LPs, even though they're under the same firm. One fund may be raised 2 years ago, the other fund may be raised 5 years ago. So this fund needs to exit in 5 years. So it just creates a lot of complexity, meaning all of this, you could say, well, do I really care? And the answer is yes, because if you come to the table unprepared to understand who you're negotiating with, You may fall prey to certain things and terms and conditions that you weren't really know that you signed up for. So by knowing this, I hope that in your next investor meeting, you're going to ask the GP who you're speaking with, hey, which fund are you going to invest in me out of? Potentially, I'm not saying that you have to tell that they're going to invest in you. What's the remaining fund life? When did you raise this fund, and how much dry powder is left? Do you reserve some of that capital for follow-on investments or not? And assuming this fund runs out of dry powder, do you have the expectation to raise another fund? And how do you combine investments, if you ever do combine investments from multiple funds? All these are very fair questions that unfortunately probably less than 2% of founders I've ever spoken with have asked me that as a VC, and I would hope more of them would. So with all the background kind of out of the way, how do you pick the right VC to work with? And some of you may say, well, Vlad, if they want to invest in me, great, I'll take the money. And I would say for early stage, and I'm talking here pre-seed, we're doing safes and everything, perfectly fine. There's no lead investor, there's no preference stack, there's no board. Do you really care who you have on your cap table? Realistically, not as much. Now, you get to the seed stage or the Series A, people may have an expectation of a board seat, they want to be much more engaged. And a lot of people are making this comparison, which I find not honestly super convincing, that picking the lead investor is like getting married, and you should spend the same amount of time doing due diligence on them. Now, I think there's a number of flaws outside of just the romantic aspect of it. Like we'll keep that out of the question. But legally, if you're not agreeing with your spouse anymore and you two choose to separate, you can get a thing called divorce, and therefore you separate. If you're trying to get divorced with your lead investor, you'll realize very early on that's actually not possible. A lot of these investments are one-way doors, and at the moment someone's in your cap table, removing them from your cap table is a very, very messy process, if it can even happen in the first place, which in most cases it can't. So should you pay a lot of attention? 100%. From a thesis fit, this is what I would say puts you in the top 50% of founders out there. Think of their industry, their stage, their business model, their geography at the minimum. Can they actually deploy in me? And why do I say can they? Remember what we discussed a slide or two ago. The GPs go to LPs and say, hey, LP, give me money so that I can invest in these companies. The LP will say, okay, what do you plan to invest in? And the GP says, my thesis is early stage AI companies in North America. Cool. That's the agreement. The GP can now invest in early stage AI companies in North America, meaning you're a late stage biotech company from Europe, not compatible. The GP can actually legally not make that investment in you. How do you know about these things? Investor databases, firm websites, fundraising newsletters. There's so many sources out there. You just have to care a little bit more than the other founders, and you'll automatically be in the top 50%. And why I say this is just anecdotally speaking, there were weeks when I would receive somewhere between 300 and 350 deals from our LPs, other co-investors, portfolio founders, founders that I know, investors that I know, etc., and cold inbound. The cold inbound pile, about 50% of it was just completely off thesis front, meaning you wasted my time reading that email, you wasted your time writing the email in the first place, just spend the additional seconds to do it. Now, if you want to take it a step further and say, let's get to a top 10% of founders raising capital out there, you have to already start thinking about the idea of value add. What can this investor actually bring as value to me? Do they have expertise, domain knowledge, and insights? Are they experts in the business model, the industry, the go-to-market motion that we're employing, etc.? Do they have a good investor network? Are they connected? Do they have a good reputation? Can they potentially interest to clients? Do they come from the industry, or do they have great industry forums or conferences or other things that are tied to that particular firm? And lastly, do they have a talent network? Have they been in the business long enough to be able to start making referrals to potential hires, etc.? Why? Because those people you lean into to provide help. And I would argue the vast majority of VCs detract value rather than add value to the founders. And why I say buy it is like they provide no actual value add, but they require monthly or quarterly reporting, and then these other things, and then we received and we've even seen others investors send things like sustainability reports and diversity reports and like all these other like reporting that you now have to do for them, even at an early stage, like pre-seed, when there's like 3 employees, but they don't really add any additional value. They're just asking for things. So for the people that you want to be your lead investor, probably you want them to be good people, ethical individuals that can provide value. This is what we call relationship-based research, meaning there's not really going to be any database that tells you that, which is why bringing great connected as founders, so making friends with a lot of founders who've been VC-backed, getting referrals from them, joining accelerators, and that allows you to start plugging into certain communities, networking events specifically for tech founders, specifically for areas like New York, SF, LA, Chicago, Toronto, Austin, London, etc. Those are hubs for venture where the local community starts getting to know one another. Super, super important to be plugged in the ecosystem, to be able to just hear the so-called word on the street, right? Really important for you to be part of that community. So how Flowlie can help, I told you I was going to add about 5% of just Flowlie in it. We have one of the largest and most accurate investor databases out there. It's our own proprietary ledger of transactions that have happened, meaning we don't look at what investors say they invest in. We actually look at what investors deploy capital in. And we do firmographic analysis over all these different companies, and then we reverse engineer the thesis of the investors. So if you do end up giving Flowlie a try, know that you will be able to actually browse a lot of active investors, get a sense of their thesis, what they're deploying in, and make a good decision on who you should start targeting or not. With that out of the way, we must ask the second question, which is, where do I fit in, let's just call it early stage fundraising? What exactly is my stage? How much am I expected to raise? What's the current valuation? Looking at the latest data that we have, that's both Flowlie data as well as external data, there's about 4 different early stage groups or stages that are, what's the word that I'm trying to find? Crystallizing, let's say, in early stage. And that's fluctuating all the time. So this is as of the last few quarters. Angel, friends, and family, still the only round right now where you can genuinely raise it pre-product, meaning I don't have anything, it's just an idea. Those are the 50 to 250K checks, individual angels, friends, family, obviously not a lead. SAFE is the instrument that vast majority of those are being signed on. That simple agreement for future equity. If that's a term you're not familiar with, I would strongly suggest reading a little bit about it. You should be familiar with the SAFE, and that is the document you should be using for as long as possible. Valuation range is somewhere between 2 to 5. Dilution is between 2.5 and 5%. Dilution means how much of the company am I actually selling for the money that I'm receiving. The valuation range, meaning after the money is invested, what's called the post-money valuation. What is the total value of the company? Pre-seeds, these $500,000 to 1.5. That's where you see a lot of angels, syndicates, family offices, and some VCs. VC participation in pre-seed has always been a topic of debate. What is truly pre-seed? At what point do VCs get involved? There are some VCs that truly do pre-seed. I would say probably one of the most famous out there would be Pair out of SF. They're one of the most pre-seed VCs out there. And there are others that are saying they want pre-seed, but they want some traction. Now, looking at the 2025 market, pre-seeds are in many cases post-traction, meaning some MVP in the market, ideally the first customer of some sorts. And the valuation ranges are somewhere between 5 and 12, which depends almost entirely on the traction of that particular pre-seed. This used to be idea stage. It is not idea stage anymore. And that's just the reality of the market. My goal here, to be very clear, is to let you know everything we are seeing in the market. It's not to sugarcoat anything. Seeds. The size of the seeds have been increasing. 3 to 7 used to be a Series A 5 years ago. Not anymore. Here we're seeing VCs, family offices, angel syndicates, with VCs being the primary chunk of those rounds. Leads are great to have, in some cases required, but let's just put it in the group of great to have. This is highly likely to be a price round, but in some cases it's going to be a safe as well. It really depends on the size. You may get away with a safe around the 3 million. You're probably going to have to do a price round somewhere around 5 million and above, meaning you're going to have to engage your lawyers and create a share class in your company that is above the common stock, which is what all the founders as well as all the additional employees are holding, and the advisors as well. Valuation range is 15 to 40, dilution between 15 to 25. Series A's. Before I jump to Series A, seed. We are seeing somewhere between 400-ish K to upwards of 750K of ARR needed to raise a seed in today's market. That is honestly wild. Seed 10 years ago used to be the idea stage, hence the name seed, and then they had to form this pre-seed, and even now pre-seed is post-traction, but seed, again, 400-ish to about 750K of ARR, meaning if you don't generate any form of revenue, you're just going to have a much better story for everything else to compensate for it. And that can be in the sense of founder pedigree, size of the market, how novel the idea is, etc. Series A is the 10 to $20 million range rounds. VCs are the primary participants in this, as well as corporate VCs. A leader investor is required. Always a price round. Valuation range is 50 to 100, 15 to 20% dilution on average. Now, Series A's, what we're seeing in enterprise software, let's just call it as a bucket, although SMB software is in a similar bucket, between 2 and 5 million of ARR. 2 on the very, very young part of that spectrum, meaning may still be problematic to raise a Series A without that type of traction. 3 to 4, solid range, closer to 5, amazing. We're seeing a lot of Series A closed last year, even on Flowlie, in that ARR range. Very hard for companies raising below, with traction below that. When we're looking at consumer, meaning we're not selling to a business, we are selling to consumers. The minimum threshold for that seems to be somewhere around 6 million of ARR for a Series A. Again, 4 to 5 years ago, 1 million was the Series A threshold. Right? You reach 1 million, you can raise a Series A. Not the case anymore, meaning Series A are more competitive than ever before. The graduation rate from C to Series A is smaller. A lot of companies die in the C to Series A stage because they're not able to make those metrics. Pay attention to this, and again, focus all your efforts into building a revenue-generating, profitable business. The time of growth at all costs, I think, may still be true to certain AI startups. It is not the case for everyone else. One really important topic that I want to mention here when we think about stages is what we call, blank on the word, milestone-based fundraising now. Milestone-based fundraising means you need to start thinking about how much money you need to raise right now to be able to reach the milestone, the traction milestone of the next raise, to obviously allow you to raise that raise in 12 months, 18 months or so from the present. Now, why is that really important? I take the analogy of a train track because it's probably one of the best analogies to make around how raising venture is. There are stations, and at each station, there's almost a requirement for you to get fuel on board. And you may choose to skip a station. That's perfectly fine. We're growing really fast. We're accelerating. We found a really efficient engine for the locomotive. We don't need as much fuel in order to be able to grow. Great. I'll see you at the next station. It's very hard to steer away from it, as we just discussed, with all the legal requirements that get placed on you the moment you accept capital from venture investors. And it's almost impossible to go backwards. It is possible, but it's going to be very painful to you and your investors. That's what we call down rounds, when you have to reset your valuation, recap the business. It's going to be messy. You can do it, but it's usually a last resort situation. Now, what happens if you stop at the pre-seed station, get $500,000, and you are at 200K of ARR? You are now in between stations. And during this time, you may raise what we call a bridge. Bridges have also had some really interesting, behaviors over the last few months. And when we look at the composition of the bridges, are almost entirely internal investor raised bridges, meaning these investors who are coming into a bridge are existing investors, they're not new investors. So almost as saying, I'm calling the station that we just passed, can you bring on a little bit more fuel to get a little bit further ahead? But if you don't make the next station, that's where most of the companies die. And when you look statistically at why most companies go bankrupt is because they run out of capital. And the reason why they run out of capital is because they don't have the metrics to raise a new round and they're not profitable. Therefore, they have to shut down. I hope that this just gives you a little bit of a blueprint of where the market is right now. So hopefully that's not you. Now, how Flowlie can help? We actually have a really good module on round planning, runway calculation, dilution calculation. So a lot of the formulas and things that I talked about, you can actually play around with it in the app if you choose to do so. So at this point, we have a very clear strategy on what I would call around structuring. Who do we need to raise? How we're thinking about it? What our capital needs? How much of it are going to do equity versus debt, etc. And what's our financial model? What that money gets us to. So how do we start getting into contact with investors? 80% of the fundraising work is in preparation. 20% of it is truly in execution, meaning budget accordingly. 80% of your time should be spent on doing research, going through all these investor databases, find the right investor, their preferences, creating those target lists. And then the moment you create those target lists, ideally find as many warm intro paths towards that investor. Plan your outreach without actually doing the outreach. And you start prioritizing based on importance, meaning the higher risk meetings go towards the end of the pile, not towards the beginning of the pile. Because as we meet more and more investors, we will naturally evolve our pitch, will get better at it, and you don't want to put your riskiest meetings up front. Now, why are we trying to find warm intro paths and not saying, hey, Vlad, I've created a target list of these 150 investors, which, by the way, when we talk about the number of investors you should be researching, we're talking between like 100 and 200 investors, not 10 to 30. You need a really solid research done because your number one job in fundraising is never run off top of funnel, meaning you start having meetings, people start passing on you. You don't want to be in a spot where you say, oh, who's next? Who should I be speaking next? You do all this work in advance. Again, 80% preparation, 20% execution. So after we get this list, why don't we just blast an email to people? Well, because cold outreach has a conversion rate of about 2 to 3% to a meeting, meaning if you put your 200 investors to through this pipeline and do cold outreach, you may get 4 to 6 meetings. Not great. So what are better converting pathways or intros? What do I mean by that? Anyone in the world that you have any form of relationship with that's willing to stake their reputation to some extent on the line and say, Vlad, you should meet Bobby, and here's why. And as a result of it, make Vlad attentive of Bobby or Bobby attentive of Vlad. And as a result, move this person up to the top of the pile for them to be reviewed. Doesn't mean that they're securing an investment. It just means that you are given enough of the brain power and time of an investor to actually give a fair shot. Now, not all warm intros are made the same. So how do you pick the best warm intro path? Existing investors of yours and portfolio founders of the target are some of the best converting intro paths out there, period. So we're talking about close to 75-ish% conversion rate, meaning people will take a meeting. Super, super important because that's what we need, a meeting. Now, other connectors could be accelerator managers, other friends, founder friends, etc. Great, they'll convert better. Cold email, as we said, 2 to 3% conversion rate. When we look at a warm intro from an investor who could have invested but end up passing, what do I mean by that? I reach out to an investor who does early stage fintech, and I'm the founder of an early stage fintech company. And they say, not interested. Cool. And I say, is there anyone else in your network you can introduce me? And for whatever reason, they're like, yeah, I'll introduce you to Johnny. And they fire off that email. And Johnny will ask them, and for good reason, hey, what did you think of Vlad and their company and all this other thing. And if they're honest, which they will, right? Because they also have a reputation to keep. It's like, hey, like, we've spoken with them. This is interesting, and this is cool, but like for these other reasons, we end up not investing. So I've artificially increased the threshold that I need to reach in order to have a good meeting. Never, ever, ever, ever take a warm intro from an investor who could have invested but end up passing. With that said, if there's an investor who's later stage, Series B or C, whatever, and they offer an intro, great, take it, because they can't invest in you. So actually, one of the next things, which is how can Flowlie help? So we built what we call a network analysis module, meaning it's a series of agents that go online and on certain network graphs. Think of LinkedIn, Google, Microsoft, and a few others, to try to figure out, is there anyone in your network that could potentially know the person you're trying to get in touch with? And we then return all these results back to you to say, hey, after reviewing your professional network, we identify that these people know the most investors you should be reaching out to. And as a result, you should start prioritizing getting those intros booked. Call those people, ask them for that introduction, and then move that conversation forward. Now, how do you move that conversation forward? And this is kind of part of the process, is you're trying to identify warm introduction paths towards your target investors. You want to activate them in a way that's as simple as possible for the person who's making the intro. So what I always suggest is have a clear ask for an intro. So send them an email and say, Bianca, thank you so much for your introduction to Joanna. I think it would be a great investor because of their expertise in fintech. Here's 2 to 3 sentences of what the company does. Here's 2 to 3 bullet points on our traction. And here's the link to the deck or the one pager and the round that we're raising. You want to make it easy for Bianca to just forward that email to Joanna and say, Joanna, take a look at this. I think this would be a good fit for you. Let me know if you want an intro. So that Joanna can review it, say, yes, Bianca, thank you for the introduction. Bianca can connect the two. Now you have a warm intro. So it's your job as a founder to make the job, the job of the person who making the warm intro as easy as possible. Flowlie can surface that the person is there to potentially make that introduction. It's your job to activate them. Now, if it's a cold email, so you end up saying, I don't have any warm introduction to this person, I just want to send a cold email. The best advice that I got in life was be brief, be brilliant, be gone, about this topic of outreach. You need to be super succinct, but very to the point, and then allow the other person to make their move. Meaning 1 sentence on why they're a good fit, 2 sentences on a company, 2 to 3 bullet points on traction, link to the deck or the one pager, brief details on the round, and a final ask for a meeting or a pass. How would early next week look like for you? Monday or Tuesday afternoon. Here's sometimes available. Otherwise, let me know if this is not of interest to you. Your goal is to get to a conclusion. And remember, the best advice that you can get on just overall investor outreach is that the goal of the investor outreach is to get you a first meeting. The goal of the first meeting is to get you a second meeting. The goal of the second meeting is to get you due diligence. The goal of due diligence is to get you an investment. Meaning, don't rush the process. Don't try to write an email that will magically get an investor to invest, because those emails don't exist and those investors don't exist either. So be succinct, to the point. You're trying to get a meeting. You're trying to give them just enough information to say, is this person worth my time? Is this a deal I see myself spending some time with? Should I meet them or not? And then use the first meeting to make your case. So how can Flowlie help with this? We actually have a direct LinkedIn integration. So if you plan to do most of your outreach to your network through LinkedIn, you can actually message your connectors, asking them for introductions directly through Flowlie, and the message will be pre-filled and personalized for each person. We are soon expand that into email as well. For the moment, it only works with LinkedIn. So taking a step back before we wrap the presentation up is, why do I need a fundraising process in the first place? And it's a fair question. And I've seen a lot of founders, for whatever reason, have really strong sales processes, really strong hiring process, really strong accounting and finance process. I doubt you don't really think about SOPs when you think about accounting and finance, But whenever it comes to fundraising, they're just like, let's throw spaghetti at the wall, see what sticks, and we'll take it from there. Because they do this a very few times throughout their lifetime. The average founder has fundraised 1 or 2 times prior to the raise that they're doing right now. So when you compare that with the investor who's coming at it as their daily job, there's a difference in the level of sophistication people are approaching to this process, which is why we created Flowlie in the first place. Because we've seen that being intentional about what you do and how you do it is the only way to predictably raise capital. Now, to be very transparent and clear here, I'm not saying it's the only way to raise the capital that you need or as much capital as you want. It's the only way to predictably raise capital, meaning you can have a funnel of 100 people that are taking you to 20 meetings, that are taking you to 5 follow-on meetings, that are taking you to 2 people in due diligence, that are taking you to a term sheet. You can systematize it and understand what does conversion look like, how do I apply best practices at each step of the way. If you don't have that, you'll be left wondering, okay, how many more investors do I need? How many more conversations do I need? And you won't be able to answer that question. So how do you run a tight process? Like, where does all of this come together? You do your research well in advance, you prepare and get as wide of a top of funnel as humanly possible. Second, you use a data tracking system. And honestly, you can use Flowlie for the investor pipelines and everything. You could use Airtable, Notion, Google Sheets, whatever floats your boat as long as you're organized. Now, would I prefer if you give Flowlie a try? For sure. But all I'm saying is that going from nothing to something is more important than anything else. So just put yourself a system in place to track your progress with investors. Have all your materials ready in advance, meaning the deck, the one-pager, the memo. Just make sure all of that is ready to go, because as you're having investor conversations, there are going to be really long days, a lot of meetings. You're going to be saying the same thing over and over and over and over again. The last thing you want to do is build a financial model at 1 a.m. because you forgot to do it and the investors require it. And you want this process to be as smooth as possible. So remove all the work from the execution phase and keep that at truly 20% versus the 80% of preparation. Prepare answers, the most common 10, 20 questions you think are going to be asked. Practice. How would you answer if you're being put in a specific corner, right? If there's skeletons in the closet, what happens when someone opens the closet? Like, have a clear understanding of all the weaknesses of your business and be ready to be able to answer those. You optimize for introductions. We already talked about it. You aim for calendar density. What does that mean? Is that great processes, as we've seen, are compact in a short period of time, meaning the goal for your preparation, the 80% of your work, should be in the beginning of the outreach phase, the I'm raising my hand, I'm in the market raising capital. You should have ideally 10, 20 meetings per week for the first 2 weeks. Now, how do you get there? By warming up all these leads in advance. And you don't want to have the same number of meetings spread over the course of 8, 9, 10 weeks, because those are processes that end up taking very, very long. Momentum dies, and it's very hard to bring it back. That's why you should send regular updates at the end of every week. You should reach back to the investor and say, hey, how did it go internally? Or we had a great conversation with you earlier this week, last week. We'd want to keep the conversation going. My schedule is already getting filled next week. Just want to make sure we have time for it in the calendar. How's next Wednesday in the afternoon? So you're effectively creating moments of updates, traction updates, commitments that you've received to move people forward. So you are trying now to shift the power dynamic from I'm operating on the investor's timeline to the investors operating under my timeline. And this is key and really important to this. All these things aside, building strong relationships when you're not raising capital is still the most important effective tactic, which means be in the community, speak with people, get feedback from folks, get introduced to investors before you need to ask for money from them. And with them, you're going to start building trust. As I mentioned, we also do have a very powerful fundraising CRM. So if you're looking for a fundraising CRM, you can use Flowlie for that as well, in addition to our research and our network analysis piece. So the last piece on the agenda, or was there a question?
Yes, we do have a question. When pitching, how firm are the deadlines that you give investors? Use of FOMO to drive investments.
Great question. So deadlines are a really, really important piece. So I'm glad someone asked this question. There's a difference between a soft deadline and a hard deadline. What do I mean by that? When you are giving soft deadlines, maybe in the case of we want to wrap up all first calls over the next week or so, meaning I want to make sure we get you booked next week or so, because afterwards we're primarily going to be focusing on second and third calls. Meaning if you come too late in the process, I just won't have enough time to get you up to speed for you to make a decision in the timeline that we have. That's a soft deadline. I'm giving you a hint of a part of the process without setting a specific date for a specific outcome. A hard deadline is we're expecting term sheets by next Thursday. Now, very different, usually used towards the end of the process if the people are moving around the same stage, which is why calendar density is so important. Let's say you have 10 meetings and they're all progressing around the same week. You're probably gonna have the second meetings, third meetings, fourth meetings, somewhere in like plus or minus 7 days by the time they reach the term sheet phase. Meaning you can afford the right, if there's 5, 6, 7 funds in due diligence, to say, thank you all, obviously independently. By next Thursday, we're expecting term sheets. Let me know if you'd be able to put one before this time or not, and we can negotiate from there. If you only have 1 or 2 investors, I would advise strongly against putting a hard deadline. You may use a soft deadline and say, hey, we have a good number of funds here. We may be expecting term sheets anytime soon. Just want to get a sense of how your timeline looks like from here. Could we be hearing back something in the next week or so? Is there anything else that you need? Again, you're still trying to drive momentum and FOMO, but you're not subscribing yourself to a hard deadline. Now, why is that important? Because that deadline may pass, that term sheet may not come, and then an investor has every right to say, hey, Vlad, how did the term sheet go? And it sucks to say, actually, we didn't get it. You've now removed all the credibility, power, and frame from that conversation. So use hard deadlines only when you generally have a lot of momentum, and that momentum is synchronized. Those would be the 2 pieces that I would use for making that decision. Otherwise, use soft deadlines. And with having said, I actually think it's a good segue towards the last piece of the webinar, which is how do you know the first investor meetings? And again, I mean first investor, meaning the first call with a new investor at any new round. You should start a meeting by asking questions, relevant questions about the investor. You should be driving the conversation. Never be the first one to answer a question in investor meetings outside of the how's the weather, where you're from, whatever. Right, so we're talking about the small talk that happens in the beginning of a call. We're talking about the due diligence. Why? Because you're setting the stage. Before we get into anything company related, I just want to make sure the right investor we should be speaking with so that we're both not wasting our time. How many investments have you made? What's your internal process looking like? What types of companies the partners get excited about more recently? How do you support your portfolio companies? Have you had a chance to review the deck that I sent over? Great question to ask, because it kind of gives you a signal. Has the person invested any time before meeting me or not? And again, puts them on the spot, puts them to explain themselves, changes the power dynamic, level sets the conversation, and the investor will soon realize, hey, I need to be paying close attention to this. They're clearly speaking with our investors. Let's figure out if we can make a deal here or not. Remember, it's a series of sprints, not a marathon. So don't do what I'm doing right now, which is just present a lot of content. This is more akin to a college level course than it is to a investor meeting. So allow the investor to engage. Use the pitch deck as an assistant, meaning don't present from the pitch deck. Don't be the type of founder who gets into the meeting, opens the pitch deck, and just goes for a 10-minute pitch. Ask the question, have you had the chance to review the deck? Okay. Were any concerns that you had? Where did it not make sense? Where did the narrative broke? Oh, go to market. Awesome. Let's go over go to market for a second. What was most concerning about go to market? This and this. Okay. And that kicks off the conversation. Compared to, let's go over product and this and this and this. When the person may have reviewed the deck, it's like, oh, product is good, team looks fantastic, but go to market, I don't know. So let's spend the next 30 minutes talking about go to market. Like, I need to answer your concerns. I don't need to answer the question that you didn't ask, right? You need to make it abundantly clear in the first few minutes what you actually do. No buzzwords. This is a really big pet peeve of mine. Founders who go into these meetings, and I know every company is special, and by definition, building a startup means you're building something that doesn't exist, or you're building it in a novel way, etc. Make it clear to understand to people what you actually do, so people have a foundation to build upon. Like, you can't impress people if they don't understand what you're doing. And there's many scenarios I can go over, stories I can tell of founders who pitched me, and midway through the meeting, I'm still not exactly sure what they do. And I stopped them and I said, like, hold, before we proceed, what is this? Like, what would you actually do? Answer the question asked. Big one. Be radically transparent. Another big one, meaning it's a short conversation of 30 minutes. You want to get a lot of information out. There's not a reason for storytelling of, oh, what's your revenue? So let me tell you, 2 years ago, when my wife and I separated and I moved to Argentina, and then from there we went travel, and that's when I had the idea about this other business, and then we did this, and then a customer dropped and all those other things. Oh, and like 10 minutes later, oh, it's $500,000. Okay, start with that. Let's see if we need further explanation, and then give the further explanation. Always in the meeting by asking what are the main concerns at the moment, because that sets your understanding of where were you not able to drive the point forward. I don't really care about what they got. I care about what they didn't get. Why is that the case? Is because that person I'm speaking with will go to a partner meeting in a few days, and they'll have to advocate to the rest of the partnership on my behalf why they should spend more time understanding my business. So if this person does not understand my business or still has some really big pending concerns, it's probably not going to do a great job. So let me find that out, so that after the meeting, I can follow up with some more sophisticated emails to say, by the way, here's how I would think about this other thing. I realized that we didn't get, a lot of chance to go super deep on this. So here's additional information about it. Great tactic. So few founders follow up after first meetings. It is such an underrated way to get in front of the rest of the pack. Now, how can Flowlie help? We actually have a calendar integration to both Google and Microsoft, and we have our own note taker. So instead of using a Fathom or an Author, etc., you can still use that in addition to it. Not a problem. The more the merrier. But you can have our note taker join all your investor meetings. You will only join investor meetings, transcribe them. They'll pass it through our filter. It's a fine-tuned LLM that analyzes the meeting, and you'll see that whole analysis in Flowlie automatically after each call with all your to-dos mapped, and also points of concern, what I was telling you earlier, so automatically be able to extract where do we believe the pitch didn't land, and also points of interest, so you can write your follow-ups with these afterwards. So, final thoughts on fundraising. In lieu of, or in addition to all the stuff that we talked about running a good fundraising process and all the caveats of raising venture capital, broadly speaking, confidence pays off tremendously. People who go into meetings knowing that they have something of worth to give are the founders who end up getting funded. Honesty pays off, and unfortunately, there's founders who are trying to hide some skeletons in the closet during the meetings, and then during due diligence, you realize very early on all these other things that were not factually correct. It will kill the deal. It will significantly damage your reputation, if not destroy it. And again, the venture community is a really small one. If you screw it up once in that way, it's going to be very hard for you to raise venture capital, period, in the CT region, potentially country. Again, depending on how problematic it is and how well known the VC is. People back people who can get shit done, meaning greatest way to get investors impressed is to tell them you're going to do something and then actually do it. Again, underrated, pretty simple. Most founders are not able to do it. No, it's nothing personal. It is an incredibly emotional process. We worked with a founder that was a customer of ours, and we ended up jumping on some chats with the platform and everything. So we got a chance to know him really well. And I kid you not, I think it was 65 rejections over the course of 3 months of pitching. It's brutal. It's absolutely brutal. And they start asking yourself, am I the right founder? Is the right business, etc. Not great. Just find ways to get yourself a support group. Having other founder friends helps a lot because they're going through the same thing. And just understand, no, it's nothing personal. And most often, not VCs are wrong. So just build a great business. At the end of the day, fundraising is sales where you're the product. Your company is the product. So you have to do the best job selling yourself and the company, but it is at the end of the day your equity, you're selling part of your company. So if the other person doesn't feel the right person to become a partner in the business and have that ownership, don't do it. Trust your instinct. It's probably one of the best things you can do as a founder. Don't do business with people you don't want to do business with. Again, a lot of what I said, it's like some pretty basic advice, but unfortunately it doesn't get followed more often than not. And if you would, we see founders have much better experiences fundraising. And again, just to close up the loop on this one, because it's really, 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 really important, never run us up a funnel. It's a sales process. Don't be the type of founder that 2 weeks in has gotten 15 rejections, 20 investors have ghosted the person, 10 intro paths never came because the founder, the other person is on holiday and the other person is on leave and the person doesn't review their emails or whatever, and you're left there, okay, so who else should I contact? Not a great spot to be in. Hopefully by being part of this presentation, you're not going to be one of those founders. And with that being said, that is the presentation.